First of all, we've got the word required. Okay, so that's what we need. That's what we require. That is our hurdle rate. So how much does the investor actually want to earn? Okay, so first important word. Then you've got the word nominal. Okay, nominal means that the interest rate must include compensation for inflation. So we've got essentially the difference between a real rate and a nominal rate. I'm going to see that. So nominal is the one that includes inflation. Real is going to be the one that excludes inflation. And okay, so if we're looking at the total required nominal interest rate for an investor, then we're starting with the real risk-free rate. Okay, so as I said, the word real simply implies that we're looking at the increase in our purchasing power measured in real terms such as goods and services, apples and pears, etc. Secondly, we have the word risk-free rate, which means that we are investing in a security that will not default. For example, we could think of the US Treasury as a default risk security. Then on top of that, we're going to add the inflation premium. So that is a premium that compensates us for the erosive power of inflation over time. Obviously, our money is going to be worth less as inflation increases or as the purchasing power of our money decreases. Thirdly, we have default risk premium. This is a premium or an additional spread over the risk-free rate that we require for the probability of default. So that would typically be when we buy corporate bonds or stocks which have a non-zero probability of default. Then we have a liquidity risk premium, and that is a premium associated with the fact that securities may be less liquid compared to US Treasuries, so it's harder for us to get rid of them, to sell them if we want to sell them quickly. And then finally, maturity risk premium is looking at the premium associated with the fact that longer dated bonds are riskier than shorter dated bonds. So this is going to be quite specific to bonds.